Welcome to this special episode of the CEC Report. My guest today is Joe Wilkes from New Zealand. Welcome, Joe.
Thanks for having me, Robbie.
Thanks for being here. Today we're going to talk about what the hell is happening in New Zealand's banks. And I've got Joe on because Joe is based in New Zealand. But Joe, before we begin, just for the benefit of the viewers, for your qualification, who are you? And explain why an Aussie and a POM, because you're not a New Zealander, are going to be talking about the New Zealand banking system.
Well, yeah, I'm not a New Zealander, but I've got three half New Zealanders, so I think I almost qualify.
Yeah.
Basically, my background, I was in the UK working and running a residential real estate business throughout the 2000s, and then I finally finished with this firm back in 2017, and I was director of the company. We spent, I guess, a lot of time looking at the build-up of the UK credit bubble, the relaxation of lending standards, the fairly dubious nature of who was being lent, how much, and without the various credit checks. And then subsequently spent a lot of time dealing with the aftermath of the banking crisis that we saw. But also, I suppose from a main perspective, I spent a lot of time dealing with the people who were suffering. The result of a banking crisis created large stresses on households, families. We saw lots of divorce cases, lots of challenges with households. And during the 2008 to 2011 period, I spent quite a bit of time talking to the banks about how they could relieve some of the pressure that was building up on households. And they came up with all sorts of wonderful measures to try and stop the debt bubble imploding successfully in one regard. The UK is still there, hasn't blown up, albeit socially you can see with things like Brexit and everything else that's gone since, there is a fracturing of society now, which I think we're going to see continue over the next few years.
So you experienced that over there, and then you moved to New Zealand only to find similar raw material. Is that right?
Actually, yeah, I came over here thinking it was the land of milk and honey, and then I realised that the milk and honey was being eaten by all the bankers, and unfortunately, there wasn't a lot left for a lot of people. We've got lending practices and I suppose a household debt issue, which makes the UK experience possibly look like a tea party at Buckingham Palace.
Wow. The main thing that Australians should be aware about when you're saying that is New Zealand is technically a separate country, but it's it's our closest brother or sister or cousin. But your banks are our banks, and that's why we want to talk about today, because the implications of what might be brewing in New Zealand, especially let's go through some recent fairly dramatic events that have happened in the New Zealand banking system. Australians should be thinking, well, hang on, they're our banks. What does that mean for us? So let's just talk about a few things. The things I've noticed that I want you to comment on. Just in the last week or so, the New Zealand government has announced a sudden deposit guarantee, and New Zealand hasn't had one for quite a while. What do you think's going on there?
We've got some major issues building in our housing market, and one of the things that I think has been neglected by a lot of the banks and the regulators is the impact that on a small country a lot of foreign liquidity can have on a marketplace, because that money, it hits a market, it hits the expensive parts of Auckland, wherever it might be, but it filters out across the country. And to compete with it, households have borrowed and borrowed and borrowed and borrowed. And I talk about the difference of lending in the UK. When we had our property bubble, there were a few banks that were going out and they were lending 5 and 6 times household income. There was instances of 125% mortgages, and we've had fairly high levels of interest-only mortgage debt, particularly in the investor sector. When you go back to where we were before we bust, interest-only mortgages in the UK were about 18% of all lending. They are around a third of all lending in New Zealand, and they're pretty similar, in fact slightly higher in Australia. I know that Westpac, by the end of 2017, for example, their Australian residential loan book was 50% interest-only mortgages.
So they're down to around the third now, because they did get very high. You're right.
Yeah. Now, what you have beyond that is the concentration of high debt to income ratios on lending. Now, the Reserve Bank of New Zealand, I think they've, with the best will in the world, they've got the right intentions, but they haven't always been given the policy tools to try and effect some form of control over their Australian overlords.
Yes.
And what's happened is that when they asked for debt to income measures back in 2014-15 to try and calm down the property market, already experiencing quite a lot of foreign cash injection, they were turned away by the then government. So the previous administration said, no, you're not having debt to income measures. Now, as a result of that, if you look at last year's lending, or
Hang on, just clarify. You're talking about controls on debt to income.
that's what the Reserve Bank of New Zealand asked the previous administration for as one of their macroprudential tools. They were knocked back, and as a result,
John Key, the Morgan, what is it? The banker knocked him back.
Yeah, he was the Prime Minister at the time. I don't think it was his decision, but he would have been involved in it. He's now chairman of chairman of ANZ New Zealand, and on the board of the ANZ Australian division. Now, the lending over here has got out of hand. I mean, from the loan reporting figures that the RBNZ publish, their last year's 2018 lending, it looks like there were 43% of loans that were written at multiples that were in excess of 5. 25% of the lending was in excess of 6, and that's 6 times household income. What I'm concerned about, and this is from digging around, and I've been doing quite a lot of work with Martin North at Digital Finance Analytics, and we've looked at some things that just don't make sense. And one of the big things that doesn't make sense is how the Reserve Bank of New Zealand are reporting their total loan numbers relative to the amount of transactions that are physically taking place in the market. So to give you an idea, if you look at the data for 2018 sales, and the one that really stands out is the first time buyer loans, because by definition, that has to be for a purchase. Buyer, it's a purchase. Yeah. Now, in 2018, there were 67,197 transactions during the course of the year in New Zealand. So the real estate figures, that's how many sales there were. First time buyers took on a number of loans that was 24,740, approximately 36.8% of the total transactions. Somehow they bought 36.8% of all the total transactions, with around 16% of the total new loans written. It's an impossibility. Same applies to the year before, and so far this year, we've got first-time buyers. The loan numbers that the RBNZ are reporting at an average of around 415,000 as an average first-time buyer loan, equating to around 37% of the total purchases that are meant to have been made, using just over 17% of the mortgage debt.
So what do you think is going on?
I think what's going on is that the banks were given one slap on the wrist a number of years ago, 2014-15. We started introducing loan to value ratios. Yeah. Now, this basically limits the size of a loan relative to the value of the purchase. No mention of the debt to income, but what I think has been happening is that, and I've spoken to a number of brokers over the last couple of months, is that most people, when they take on a mortgage for a first-time purchase, it's not everybody, but there is a large proportion, are actually taking on more than one loan as part of their overall mortgage exposure. Often one part slightly larger than the other. It's not uncommon, for example, for someone to take a wonderful one-year fixed rate with $400,000 of the mortgage, and then $200,000 is added on a 3-year fixed rate to spread the interest rate risk in the future. So the bank's reporting the loans, but no one at the Reserve Bank of New Zealand has been checking actually against what the total number of transactions that the first-time buyers could have been responsible for. Overall, new lending, first-time buyers as a proportion of loan numbers represents between 10 and 12% fairly consistently over the last 18 months.
So you're saying that the debt that the new home buyers are taking on is probably much bigger than is being reported.
The concentration of debt in the system, I think, is higher. So there's lots of people in New Zealand who don't have a mortgage. We've got a third of the country who do have a mortgage. And those people, particularly the late entrants, are taking on bigger mortgages because there hasn't been no control over how much they've been able to borrow.
Is anyone else talking about this other than you?
There are a few voices that are commenting on various news sites and supporting some of the work that digital finance analytics are doing, but nobody in the wider press are talking about it. I have had discussions with people in the press about it, and I have raised these numbers and this concern with people who are employed by the Reserve Bank of New Zealand, and indeed people who were formerly employed by the Reserve Bank of New Zealand. There hasn't been any public discussion about it, however. But what we are seeing is a lot of noise in the banking sector at the moment.
Well, you might also be a living example of the fact that it takes an outsider to come in, and especially with your experience of what happened in London, and say, I see all these same elements at play here. I just came back from a trip to Western Australia, for instance, where John Adams, the economist, and I were taken around the northern suburbs of Perth by an Irishman who lived through the crash in Ireland in 2008, and he's seeing things in Perth that none of his friends can conceive of as being a risk, right? But it's sometimes what's the saying? In the land of the blind, the one-eyed man is king.
Yeah.
So these are things that when you look at it, you have to think, well, these are risks that are not just in the property market, they're risks for the banking system. And is that what you think the Reserve Bank and the authorities are thinking about when they're suddenly saying we need to put a deposit guarantee on? What would their concern be with the deposit guarantee?
Well, I think from a household perspective, there is a risk. We have got bail-in legislation in New Zealand. Very few people in New Zealand are aware that we have bail-in legislation, but it was passed again by the previous Key administration back in 2016. Not so much fanfare, and if you go into any bank, and we've tested this, we've gone in, we've walked into banks, we've spoken to people who are taking deposits from customers and asking them if they know what bail-in is. The bank staff don't have a clue. I went into 6 banks not very long ago for DFA, and of those banks, the only bit that anybody was able to find out for me about bail-in, and they were all asking the other members of the teams, was when someone Googled what is bail-in and came up with a digital finance analytics post about it. So banks don't know, but what the big risks for New Zealand are that because we are so dependent on 4 Australian banks for 85%, they hold 85% of the mortgage debt in this country. They hold a similar amount of the deposit debt. You've got a very cloudy bail-in issue, but without higher regulatory capital requirements, and the banks at the moment, they are holding capital beyond the Basel III doctrine, but there is a risk that if something like Westpac, with their big interest-only loan book and a falling housing market in many places in Australia, if Westpac say, oh, right, we could do with some more capital, it would be very easy to skip over the ditch, help yourself to the excess capital beyond the requirement levels of the New Zealand subsidiary, and fund and recapitalise the Australian arm.
And
so from a New Zealand perspective,
just clarify, they're allowed to do that under New Zealand law, right? The parent bank in Australia can come and grab and leave what, just 8.5% capital, something like that?
Currently, and the challenge is people talk about them as being separate legal entities, but where do the profits go every year? They disappear back over the ditch. And yes, there are New Zealand bank shareholders, and there are pension firms in New Zealand that own shares in the banks, but the profits are largely finding their way back to the Australian parents. So it is a risk, and as a result, because of the lending practices that you've seen in Australia, that I know you exposed with Philip Seuss, those practices, they haven't been the same in New Zealand, but there's lots of similarities.
Yeah.
And therefore, we need to factor in, and I support the need for higher capital. I provided a submission to the Reserve Bank when they were asking for submissions on feedback on do we need higher capital in the banking sector. Now, I was one of 64 submissions. So we've got a population that aren't really that aware of this, because we have got a media that neglect business information and business news. For example, yesterday I watched the news in the evening. Not a single person mentioned that our biggest exporter of agricultural produce, Fonterra, big cooperative, their share price fell 6.5% yesterday to a market capitalisation of 5.54 billion. Now, I know just off the top of my head that they were carrying debt in excess of 6 billion last year. So things they don't get spoken about in New Zealand. Everything is awesome, and we don't, we don't talk about the things that actually are real and are happening under the surface. So yeah, I took umbrage to it probably about 7 or 8 months ago. I happened to be in Australia for a weekend. I thought I'd call Martin and say, look, I fancy offering an alternative press with a bit more information, a bit more guidance.
Well, and can you comment just before we go on the reception that your and Martin's posts on digital finance analytics are getting over there? Apart from the one you just said about in the bank, I understand you're getting a good reception, but you're also getting some strange things by Google.
Yeah, well, it's difficult. I think the thing we're finding, and to be fair, it's happened more since the Christchurch terror attack, and I can understand, the need for certain things not to be spread. But there are posts that we've put out recently that haven't been captured by the various algorithms on YouTube, and therefore have just sort of disappeared. The key, I think, is just not to mention New Zealand anything. And then it gets picked up. So we've done some good posts that have covered New Zealand and Australia under different names.
Well, Joe, you've just fueled our suspicion, I must say, because we've been monitoring these laws post Christchurch, including the ones that New Zealand and Australia are pushing around the world to allow more internet censorship. And of course, it's billed as cracking down on violence online, etc. But we read the fine print, and the fine print can get very broad and come up with all sorts of things that are more political, etc. And it comes down to who gets to decide what that is, right? And if you're already experiencing that with all you're doing is you're not controversial outside the economic sphere at all. And if you're already being caught in that, that's not good. So anyway, let's hope this gets a good airing.
Yeah, we'll see.
So among these actions of the banks that we've covered so far, they put on this. They're now going to put on this deposit guarantee quite suddenly, which the majority of Kiwis didn't realise they didn't have a guarantee, which also says something about the Kiwi system. They've got bail-in, which most Kiwis don't know about. It's called open bank resolution, and in fact, it's the most. As an outsider, I was always struck when we first came across New Zealand bail-in. It's the most explicit bail-in regime in the world, right? And the only political reference I ever saw was by Winston Peters raising some questions at the time it was passed in Parliament. He questioned some of it, but apart from that, nothing like the backlash that we've generated here in Australia. You've got the Reserve Bank, though, is now in an argument with the private banks over these capital requirements, right, that you mentioned, right? Because the private banks are not that happy. And the private banks made this submission to the Reserve Bank recently saying, we don't think you're going to bail us in, and we don't think you should. Now, I would agree with the second part. I don't think they should. But the denial of the banks, the Reserve Bank put them right back in their box, right, and said, no, these capital requirements are going in, and they include bail-in.
Yeah, well, Adrian Orr hit hero status for me on that, was he gave them a public slap on the wrist at the last financial stability report. But it is interesting since then, the narratives carrying on. It's been clouded a little bit with the various misdemeanors of the ANZ CEO. He left initially, wasn't very well. Then it turns out he wasn't very well. Don't know whether it was because he'd been borrowing a little bit more than he should have done from shareholders.
So that's what you're suspicious about, right? That the official story doesn't wash with you about this departure.
Yeah, it doesn't. I mean, there's too much murkiness under the water. There was a house purchased by ANZ under a subsidiary company back in 2011 for Mr. Hisco and his wife to live in. I don't have an issue with that. That's not a problem. You buy your executive. It's, corporate relocation is quite common. I don't have an issue with him storing his wine in Australia, probably to avoid import duty into New Zealand. If you want good stuff, you have to pay for them to do certain things. What I do have an issue with is when 6 years later, after an ANZ-funded refurbishment of the house that they bought for Mr. Hisco, the house was then sold. You got to think we were going through a property boom where the Chinese and the debt levels were rising. People were buying everything that came up, and prices rose exponentially. The house got sold at a loss from the purchase price. which is murky, and I don't like murky. I like transparency.
You're being too kind, I suspect. Murky.
Yeah, well, it never saw the open market. It was sold at a loss, and the new CEO or acting CEO of ANZ was one of the three directors that signed the paperwork on that loss. So that's shareholder fraud, in my view. It was an asset; it had gone up, and the shareholders have been diddled. So what unfortunately has happened is that this has got so much news in the press that we've forgotten to talk about the other things that are going on, which is the battle between the banks and the Reserve Bank of New Zealand. There's not been very much discussion about what the banks have actually been saying to the Reserve Bank of New Zealand. Westpac's submission, they said, well, if capital ratios are going to go up, we'll either have to look at how much money we lend into the market. We may have to reduce our exposure to New Zealand. Oh, and we might have to sell. Now, if that's not a veiled threat,
yeah,
I don't know, but these things don't get talked about in the press. Following on from that, you then had the bail-in, the depositor guarantee announcement. The detail of that will take some time to iron out. What I'd like to know is who's doing it and at what point will the depositor guarantee kick in. In the UK, where I've come from, depositor guarantee kicks in at the point the banks fail, not at the point that they need recapitalising. So again, how transparent will this process be, and will the general public be made aware?
Because New Zealanders, like in Australia, they shouldn't assume that a deposit guarantee suddenly means their money's safe from bail-in, because they're actually separate processes.
Absolutely.
If they have to recapitalise through a bail-in, they'll do that and say the guarantee is just if the bank goes under, but bail-in stops the bank from going under. And just to emphasise, so with the shenanigans around the ANZ boss, one of the factors there is ANZ is by far your biggest bank, right?
Enormous. They've got the largest exposure to our mortgage market. We have got one of the most expensive housing markets in the world. In 2016, The Economist published data that said that we were the highest in terms of debt to household income measures, debt to rental income measures. We're off the chart, and we actually I ran a post not very long ago where we talked about the comparative price of some of the main cities around Australasia, and at the time we were using an exchange rate of $1 for New Zealand to $1 Aussie, and Auckland is not as expensive as Sydney, but more expensive than Melbourne on a dollar for dollar median price purchase. Yep. Wellington, which is it's a small city, more expensive than Brisbane on a median house purchase for purchase. I can't think. I think they were the two, but it was it's shocking how expensive, because wages here are lower, interest rates largely similar, slightly higher mortgage rates at the moment. So things don't make out sense. But we have to grow our household debt, and unlike a lot of the rest of the world where the growth in household debt plateaued and didn't carry on going up like yours has and ours has, New Zealand successfully increased our household debt from around 150 billion New Zealand dollars back in 2008-9 when we had a financial crisis. We've now got over $265 billion of household debt. The agricultural sector is screaming, and it's not that everybody's in debt, it's just that those that are in a load of it. So yesterday we had one of our West Coast farms sell. I talked about the cooperative Fonterra and the challenges that they're experiencing, having to sell assets that are performing to cover off the debts that they've got on the non-performing assets. So ANZ's very exposed. They are by far our biggest lender, and they're throwing the toys out of the pram at the moment.
Well, let's just conclude this just with a brief discussion about Glass-Steagall, because as you know, we have a campaign here to break up the banks so that they can, we've got to stop the banks being able to do this excessive lending, which comes under commercial banking, but it's actually speculation. That's why the banks are doing it. Very profitable. I think I've seen the figures where the per capita profits of the Australian banks, New Zealand subsidiaries, is like $200 higher than what they're getting out of the Australian public. So we're really, thanks to this method the banks are using, we're really extracting the profits. So we need that kind of structure in New Zealand, right? So we can start reining in what the banks are doing.
Yeah, I mean, if you look at New Zealand, and I know that you've talked about it in Australia, we don't really know how much exposure that the banks have. The derivatives that back in 2015, October 2015, and reported on in early 2016, there was a report done by who was it? It was KPMG, I think, on derivatives exposure held by the New Zealand subsidiaries of the Australian banks. At the time, derivatives exposure was about 2.7 trillion New Zealand dollars. I can't find since then where that's reported. So that's one thing we don't know. I'm a big believer of we've had an issue that's built over the last 40 years because there's been too much lending for financial asset transactions.
Yeah.
And this money gets created. So the money gets created when a loan is written. The loan creates the deposit on the bank's balance sheet.
Yeah.
And that is what we pay for over 30 years. Now, you keep pumping money into financial assets, you kill your productive economy. We've killed ours in the UK. So part of me doing this is shit, we really fucked up in the UK. Don't follow what we did. We need to try and get a balance of the regulators understanding credit creation better and trying to focus the credit creation into productive sectors of the economy that don't create these big asset booms and bust, but do allow for businesses to provide jobs, improve people's lifestyles, provide infrastructure services, all the other things. And until we've got that, we're going to continue through this boom and bust cycles, which you haven't experienced yet properly in Australia and New Zealand. You will.
Which is one of the problems, obviously, in terms of understanding this.
You will experience it because private debt's out of hand. And the way that they tried to solve it in the UK was we pushed interest rates down to nearly 0.25%. We started when we hit our straps with, base rate was around 5.25%, and we were at 0.5% within 12 months. You can't go much lower, and your debt is a lot bigger in terms of proportion of household debt to GDP. Now, the way that we tried to overcome our debt issues were cheap money, more government spending. We had our austerity, but actually there was a lot of stuff that was taken off the bank's balance sheets to keep them maintaining lending into the private sector. And what the other thing that wasn't talked about in the UK was we opened the doors, and we invited the population of the UK, of New Zealand, another 4 or so million people into the UK over the last 10 years. And I don't have anything wrong with immigration. It's not a bad thing. You get new minds, you get a bit of creativity, you get people who want to go and improve their lives. But the challenge is if you've not prepared for it, you get social pressures of not being able to get into a school that's on the doorstep and you're driving across town in heavy traffic to get to the school on the other side of town. So you have to be able to prepare your infrastructure for the increase in the population rather than increasing the population, just hoping that.
Right. It's not demand driven. It's done to stimulate, and the needs of the community come last. In Australia, there's people here who call it population QE, right? Using the population as a stimulant. Well, Joe, I want to thank you very much. You and I are going to talk a lot more about this.
Look forward to it, Robbie.
But for the viewers, just to emphasise for the viewers, New Zealand's banks are our banks, and Joe keeps a close eye on what's happening over there, and there is a chance. There's an agreement between New Zealand's regulators and our regulators to deal with to coordinate their response to a crisis. We know New Zealand's got bail-in. We know Australia's got a backdoor version of bail-in, and when you start to see the kinds of rumblings in the New Zealand banking system, like Joe's talking about, that he's talking about it uniquely because no one else wants to, right? Which is not dissimilar to what we're talking about here, except there's a lot more people, thanks to people like Martin North and John Adams, etc., that have started to get attention onto it. When you see that, you got to realise there is something wrong, right? So we'll monitor this closely, stay in touch with Joe, and hopefully achieve the kinds of reforms we need on both sides of the ditch, Glass-Steagall, etc. So, Joe, thanks very much.
Thanks for having me, Robbie.